Well, hello everyone. Thank you so much for taking the time to join us today and welcome to the Tax Saving Strategies for Small Businesses webinar. My name's Armand. I'm part of the client success team here at Knorr and I'm delighted to be your host for today. Joining me today is Tom Francis. Tom is a chartered accountant and head of accounting here at Knorr. Tom, thank you again for taking the time and for being here.
Yeah, lovely to be here, Armand.
Then just a bit of Knorr in case you are not familiar with Knorr. We are an award-winning online accountancy and company secretary practice catering for small micro businesses and SMEs in Ireland and the UK. We are proud to be recognized for our excellence in providing services, and we believe in offering our clients with top-notch solutions catered to their unique business needs. Our team consists of highly qualified professionals who are members of Chartered Accountants Ireland, and embracing technology is at the core of our operations. We utilize digital processes to streamline your accounting tasks, making them more effective and hassle-free for you. Within our firm, we do have a diverse range of expert teams. These are accounting professionals, company law professionals, payroll specialists, in-house bookkeeping, and VAT experts as well. We've got a client success team that you'll be working close with, and then for new clients, the client services team will be your point of contact. Collectively, these teams form the backbone of Knorr. For today, the goal is to make the webinar as interactive as possible. So we would encourage any questions from your side. If you have any questions related to a topic at hand, please feel free to pop them in the chat for us to attend to, but we will have a Q&A session right at the end as well. There is a lot of things to go through, so I'll get right into it. Just before I do, though, it's very important to note that the information that we are to share today in the webinar is general information, so it's for general purposes only. If you have any specific advice that you seek, we always suggest reaching out to your accountant. If you don't have an accountant, you are more than welcome to reach out to us on hello@knorr.com. So for today, the agenda will be to understand how business structures impact tax planning. We'll learn how to optimize business expenses to maximize your tax benefits. We'll look into strategic salary structuring, understanding the importance of compliance with tax regulations, and we'll look into harnessing the power of accurate financial forecasting. So with that, I'll hand over to Tom.
Thank you, Armand, for that great introduction. I think to your point, yeah, let's make it as interactive as we can. We kind of learn what our participants would like to know, I suppose, via the questions, and we can always tweak any future episodes in that regard. With regards to the webinar this morning, yeah, I mean, optimum business setup is probably, the optimum place to start almost, because if you haven't the right structure, yeah, you're off to a bad start, or you mightn't be as get as many benefits as you could or should be getting. So that's why we picked this as our first strategy. Now I'm obviously conscious that we may already have some attendees who are already set up in business, and that's okay, because sometimes our clients might be a sole trader, but optimum structure could be a limited company, or vice versa. So you can always change, is my point there. So setting up as a sole trader, I mean, it can be done for very little cost and very straightforward to do. And that's often done by business people setting up for the first time. They're not sure if the business is going to be successful or not, and they want to see how it goes. And as I said, it's very little cost. And all you're doing really is registering with revenue for taxes. And if you'd like to register a business name, you could register with the CRO. Again, very little cost, few €100, I suppose is where we're at here. Sole traders have unlimited liability, meaning the personal assets could be at risk if the business incurs debts or was to fail. Business owners tend to be taxed on the profits of the business, and tax rates personally can exceed 50% plus for higher income tax brackets. So for sole trader, it's good insofar as little cost. The downside can be sometimes the unlimited liability and the higher tax brackets, and I suppose just to be aware of that. Whereas with companies, then, you have the limited liability piece, which is really a protection for its owners. Your personal assets are generally protected if the business incurs debt or is to fail, and that's a huge thing. family home doesn't tend to be at risk in those situations. Companies pay corporation tax at a rate of 12.5% on the basis that the business is Irish tax resident. And that certainly, yeah, it beats the sole trader income tax rates of 50% plus. Our clients who are operating as limited companies find that operating as a company tends to give the shine of credibility, stability, and potentially makes it easier then in the longer run to attract investment, secure new business deals, et cetera, et cetera. Now, there's always a downside, I suppose, to everything. And with companies, the downside probably is the red tape or the compliance requirements, because with companies you have to submit a corporation tax return to revenue, you have to submit an annual return to the company registration office, and kind of keep up to date with your filing requirements. So there's a little bit more red tape with companies, which must be borne in mind. A company will have directors who are running the company on behalf of the shareholders, and there's responsibilities that come with that as well. So yeah, it was just to bear that in mind. Now, as an accountant, I often get asked by clients or prospective clients, well, what should I do? Which option should I take? And the thing is, there's no rule book around the answer here. It really just depends on your personal circumstances, and what you're planning for your business. Because I would sometimes see a limited company in operation, and that could easily be a sole trader, given the level of risk involved and level of revenue and profits, etc. But if you plan to, I suppose, grow your business, like reinvest the profits, the 12.5% tax rate tends to be the way to go. If your business involves risk, forming a company will protect your personal assets in most cases. And as I said, if the business is going to be kind of just a small little test piece, that you hope will grow into something, you could set up small as a sole trader, and then in a year or two's time, when you're comfortable, set up, set up as a limited company, then you can bring the business into a company. But always, I would say, always talk to your accountant, tax advisor, other people who've done it, to get kind of, I suppose, different views on things. The challenge is, though, there's no hard and fast rules, and there's no one size fits all, Armand, in those cases.
Yeah, and like we mentioned, or like I've come to realize, each business is unique and has their own objectives. So like Tom said, it's definitely something to consider. There's pros and cons to both ends. Before we move on to the following topic, I just want to check with the attendees if there were any questions at hand. If not, or perhaps that comes throughout the discussion, we'll have that session right at the end again. But please feel free at any time to pop any questions in for us. Tom, I'm moving on then to optimizing business expenses.
Indeed. This is one that's really important, I suppose. I find from working with business owners that sometimes it can be underrated in terms of how to minimize a tax bill. Yeah, so keeping great accounting records or good accounting records, having accounting software, because what you want to do is you want to record your sales invoices to your customers, your purchase invoices from your suppliers, your receipts and your payments through your bank account, could be your credit card account, whatever accounts you have, because you want to have kind of a good picture of the activity that took place during the year. From the point of view of maximizing your expenses, of course, it has to come down to keeping the purchase invoices, the receipts, evidence of the fact that I can claim this expense, because that's really what the tax people will look for if they are carrying out a review. Show me the proof of that expense. Now, on accounting softwares, now you can keep copies of those invoices and receipts and all that. You don't have to keep the physical copies anymore, which is really brilliant. So most of our clients now would just keep the invoices on their software. You can scan them. You can scan them in. Like if you're using Xero software, you can scan the invoices in through HubDoc. The invoice lands in the software, and you're just allocating the invoices, then approving and allocating. So it's much simpler. You can do that on the go, which is brilliant. But my point earlier was keeping evidence of your expenses, because what what I'd like everybody to, I suppose, appreciate is that a payment from your bank doesn't constitute an allowable business expense for tax purposes. That just shows you paid somebody. You have to have the backup for the payment, whether that's an invoice from your accountant or from your suppliers or whatever that might be. It could be the, you know, the phone company or the utility company or your insurance, keeping that evidence. So in terms of expenses you can claim, then there's no exhaustive list. It's open-ended in many ways, because, you know, like we said earlier, with the structure of a business, you know, can be unique. So can what expenses you can claim. So there's no hard and fast rules. We'll cover the general detail, I suppose, in terms of what you can claim. But before that, we said we have to keep a copy of the invoice or the receipts, etc. But also then, okay, you're justifying why am I claiming this expense? So I would always encourage my clients to ask themselves the question, would I have incurred this expense if it were not for the running of my business? So if I wasn't in business, would I have incurred this expense? Yes or no? And the answer to that question generally would be a pointer in the right direction. Like I'm paying the accountant, I'm paying the solicitor, I'm paying for supplies, I'm paying for business insurance. Would I have incurred that expense if I wasn't in business? And if the answer is no, then you generally you know then that it's going to be allowable. That's it in a nutshell. If you have difficulty answering that question, it could be the fact that it might be some of the expenses allowable and some of it's not. So I suppose just bear that in mind. But I suppose always challenge yourself on that one. The main allowable expenses in most cases, things like you're talking about things like materials, you're buying supplies, rent and rates, you're looking at insurance, you know, your telephone broadband costs, advertising, Google AdWords, that type of stuff, consultancy, wages tends to be a big one for those businesses that employ. You might have a business loan, it could be interest costs. So like I'm like there's nothing hard and fast here. It's just, you know, anything and everything. Wages, as I said, directors' salaries tends to be one. If you're a sole trader and you're paying yourself, that's doesn't tend to be classified as wages. It's drawings. And drawings paid to a sole trader, the proprietor, doesn't tend to be an allowable expense because the sole trader is just taxed on all the profit. So let's say with the sole trader, you know, you record a profit of €50,000 for the year. It's taken that 50,000 that's left in profit is yours. You can do what you want with it. So you're just taxed on the 50,000, whereas with companies it's a little bit different. And so there's some nuances with how you account for both, but just to be aware of that with a sole trader, it doesn't matter how much you take out as long as there's enough money there to take it out. Companies can be very restrictive in terms of what you can take out and when you can take it out. So yeah, just to be aware of that. With companies, with businesses, I should say as well, if you own a private motor car and you're doing business trips, there might be an allowance there for business travel as well. So just to be aware of that, don't overlook it, I suppose, because sometimes it could be a credit that's allowed at the end of the year in your accounts, for example. So just be aware of that. Something that we remind our clients as well is around the small benefit exemption. So that's I suppose essentially it's the gift cards that you can give to yourself as a company director or to your staff, etc. But it's where companies allow, or businesses essentially allow rewards to their employees with vouchers without incurring any additional tax liabilities. So the business can get a tax write-off, but the employee gets the non-cash benefit, i.e. the voucher tax-free. And for 2025, I suppose the changes happened there is the voucher or the non-cash benefit can be €1,500, which is really good, and 5 benefits per year. Anything above the €1,500 is taxable. So just to be aware of that. But a lot of our clients would tend to use it towards the end of the year. So like back in November, December time, coming towards the end of the calendar year / tax year, there was a lot of I suppose rewards given in that fashion. So yeah, it's a good one. Okay. Capital allowances then, Arman, we might just look at that as well because that's kind of part of the expenses as well. Capital allowances, they're an unusual one. So they're like tax deductions that a business can claim when you buy certain types of assets. So things like machinery, equipment, vehicles, things that kind of cost a little bit more. So, you know, you could be talking about a motor vehicle or production equipment or that type of stuff. You know, so you get tax write-offs for all your expenses, but sometimes it's done in different ways. So with the assets, the bigger stuff, the heavier stuff, you're getting the tax write-off over a period of time. So I'll give an example just in terms of how the regular capital allowances piece works. So you have my example here is we have a small bakery, and the name of the bakery is called Sweet Treats. It's based in Galway, and revenue €200,000 with 8 employees. So they've purchased equipment, industrial oven for €16,000, which excludes the VAT. And under the capital allowances scheme, what happens is they can claim an allowance of 12.5%. 12.5% is the general rate of capital allowances. So they can claim 12.5% of the cost of the oven over 8 years. So over 8 years, basically, they can claim the full cost of the oven, essentially. They can claim €2,000 per year from the taxable profits. So reduce the taxable profits by the €2,000, which is, you know, €16,000, the cost of the oven at 12.5% per year. You claim that over 8 years. So when you're looking at your accounts then, and I'd often find when we're looking at going through the accounts with our clients at month end or year end, there might have been an expensive purchase like the industrial oven, but it's not in there in your actual expenses. It's sitting on your balance sheet under assets. And that's the reason, because it's not a full expense in the year. It's an expense that's kind of written off over the 8 years. And in your profit and loss account or your income and expenditure account, you should see things like depreciation in there as opposed to the full cost of the oven. So just something to be aware. And your accountant or tax advisor will be able to make sure you get the kind of the most tax efficient claim on the cost of the oven or whatever the industrial equipment or other equipment you're purchasing.
Tom, this might be a bit silly to ask, but just from my understanding, I suppose, and maybe for some of the attendees as well, would that be on multiple machineries, or would you be limited to a certain amount of machineries you can claim back over the 8 years?
There's no limit. Essentially, it goes back to the asset or the machinery or whatever it might be. Is it for the business? So you treat it exactly the same way as you would have in your, you know, as a regular business expense from that point of view. So if I'm buying it because it's needed for the business, then no limit. You're only limited, I suppose, by the cash flow of the business really, and you know, and how you'll cover it. So yeah. But no, I think that's a good enough good question there. Now there's another, so that's just the regular capital allowances. You get 12.5% per year over 8 years, done. And that goes into your tax return if you're a sole trader, or if you're a company, goes onto your corporation tax return. So same treatment there really. There's this thing then called accelerated capital allowances. And the best example here is where you're purchasing energy efficient equipment. So the best I can think of here is like an electric car, for example. It's energy efficient, and that's one that the Irish Revenue give as their example as well. So if you have a small consulting firm in Cork, they decide to buy an electric car, business use. They want to reduce the carbon footprint, but also take advantage of the tax incentives that are there. What's great about it is, if you buy, let's say, a Nissan Leaf, €30,000 in 2024, you can claim the full cost of the car as a tax write-off in year one, subject to a limit of 24,000. So revenue capped the cost of those items at 24,000. So in year one, then your taxable profits is reduced by the full amount, yeah, you get the tax write-off in year one. So I would just like again, so there's options there that you know, you generally might not be aware of. So just make sure that if you are thinking about buying something, that you speak to your accountant, tax advisor, etc., and they can kind of guide you in terms of, and they'll be aware as well, just in terms of what to look out for at the year end as well, because you know, it's all the small things kind of could add up to a big tax saving at the end of the day.
Definitely.
Yeah. And staying on company cars then and benefit in kinds, Yeah, so when a company provides a car to an employee or a vehicle to an employee, just to be aware that this benefit in kind piece is always to be taken into account, where you basically get some personal benefit out of being provided with the vehicle, and that could mean the fact that you don't have to buy your own vehicle, and the company then is footing, the tax, insurance, depreciation, and all that sort of stuff that comes with owning a car. Could be any type of. We're not talking about electric cars here now. We're just talking about a vehicle. Um, so you could have use of the car vehicle in the evenings, weekends, etc. How that works is on the payroll, there's adjustments to be done for the benefit you receive. So if you have a company vehicle, just to make sure that your accountant is this benefit in kind being included, and if it's not, that's fine too. But just make sure that both sides are comfortable. Um, with Budget 2025, which was announced last October, the government announced a new benefit in kind exemption around the provision of electric vehicle chargers as well at the home of a director of an employee. So that's potentially a good one as well to be aware of. So if you have a hybrid car where you can have a charger to charge it, or a fully electric car, there's a charger purchased, the business can pay for that, and there's no personal tax for the director or employee. So again, something small, but it will definitely help.
Tom, I think that's sage advice. Just one thing on my mind that I think some of the attendees might think of as well, especially in this where you get different formats like hybrid or even complete remote work. In terms of relief, if I've got a home office, I can claim heat, internet, electricity, and so forth.
Yeah, sorry, you can, yeah. So what happens is, right, if you're working from home, as would happen a lot, with business owners or some regular employees, depending. But let's keep this on business owners. So rule of thumb, I suppose, essentially is business owners can claim 30% of the light and heat, the broadband costs, those costs that are, I suppose, attributable to, you working from home essentially. So I need the light and heat, the lights are on, the heat's on, and I need the broadband as well. And revenue they're comfortable now with the 30%. So when a tax return is being prepared, completed, you know, all you have to do is keep a record of your light and heat. That could be your central heating costs, could be your gas, oil, electricity, and then your broadband costs, generally speaking. Keep those bills, and then at the end of the year, then they go on to a calculation is done for your tax return. I've seen revenue come back and question those numbers. So as long as you have the breakdown and the backup, you're fine. Now, there's normally an adjustment done, Armand, then for the amount of days you're working from home over the total amount of days in the year. So for example, you could be working from home. Well, there's 365 days generally in the year, right? So basically, just to be wise, that you can't be working from home 365 days because of annual leave, etc., etc. So take out the annual leave, and then take out any other days where you might not be working from a home office. You might be on client site, or you might be working from the actual office or whatever. So just I suppose it's better that you're making those adjustments from the get-go, as opposed to revenue come back and question the number of days. I've seen it happen. That's how I can talk about it so clearly. But otherwise, yes, there's an allowance to be done there. And for business owners, for companies, like for example, that adjustment can be done as part of your year-end accounts, for example, and a credit given to the director. So for example, I didn't actually get paid 30% of those costs by my company during the year, but I can tell my accountant at the end of the year just to put the adjustment through, and you can get paid then. If there's money owed to you, as a director, you can literally take it out. You can pay yourself that money tax free. Was the key as well.
Now, I think that's something that many might not be familiar with, and definitely something worth discussing with your accountant. Tom, do you mind if I move on to the following one? You mentioned the business owner, and I know salary versus pensions is the next one, and I think that would be an interesting topic to explore next.
Sure, yeah, yeah. Okay. So strategic profit extraction. Yeah, so this is an important one, I suppose, insofar as, what options have I got to take money out to pay myself, essentially. There are a few options to pay yourself as a director of an Irish business. As I said earlier, with a sole trader, you're taxed on the profit. So this section doesn't necessarily apply in that regard. But again, it's important to be aware of that also. So with the company owner directors, you really have two main options for payment. The first one is salary. So you take a regular salary, generally monthly. So salary to company director paid monthly. Simple. Shareholders now are different to directors because shareholders own the shares where directors run the company. Now, with smaller businesses, the shareholder and director can be the one person. But just to be aware that a shareholder can't take a salary unless they're actually registered as an employee of the company. So, for example, they could be employed as a director, just to be aware of that. With pensions, then, one thing I always say in pensions that there's no more efficient way of paying yourself than than get money out of your company than through pensions. It's just simply the most tax efficient way ever, I suppose, of paying yourself as a company director, because the company can move funds from its bank account to your pension, and generally it's relatively tax free. Now, regular employees who pay pensions and make employee contributions, that's taken out of their wages. With directors, company directors, it's not. They get their regular wages, and then the pension can be paid over as well. And there will be limits and all that sort of stuff, but generally speaking, it's an option that most of our clients would avail of. Not so much at the start though, because at the start there's where cash flow can be tight, it's not exactly a priority. But I would say, like, once you're set up and kind of you might be set up for a year, 2 years, even start small and get into the habit, because it all adds up later on. Where the tax happens on that situation for company directors is on the far side. So when you go to draw down on your pension when you reach retirement age, that's where you get taxed, but not on entry. So revenue do get taxed somewhere along the way, but just on this side, it's good. It's a pension funds tax free. Now, again, I get asked a question quite often, like, should I take a salary or should I take a pension, or what's the best thing to do? Well, you need to take a salary anyway, because you have your bills to pay, you have your rent or your mortgage, all that sort of life expenses, etc. So that has to be done. And then the pension is kind of for the longer term. So generally speaking, a combination of both generally works best, I would say. So factor that in. Just a tip then. So if you own shares in a business, selling the shares can sometimes be a great option for shareholders looking to extract value from a business, because it's selling shares is taxed at 33% as opposed to the higher income tax rate. So sometimes, yeah, working towards the capital gains tax rates for certain things is more beneficial if you're in that situation. The closed company surcharge then is just important to be aware of in this. The closed company surcharge is where you have generally an SME, where it could be involved in professional services, or the company could have investment property or investment portfolios, and it generates kind of surplus at the end. Well, if that surplus is not distributed in dividends is monies that are paid to the shareholders, profits that are distributed to shareholders. But sometimes businesses don't pay out the profits; they just leave them sitting there. And if you leave them sitting there, revenue tend to apply additional tax bill, essentially. Just beware of that. Because sometimes our clients get caught out in that as well. So does the dividend be paid to save tax? Sometimes it's more efficient to pay the dividend. Sometimes clients decide, yeah, look, I'm aware of it. I don't want to pay the dividend this year. I'll pay the surcharge. That's all well and good, but just so you're aware that happens in those situations. Okay, and then I suppose aside from the kind of the salary, pension slash dividends piece, there's a few other kind of high level areas where you can, I suppose, extract profits from your company tax efficiently. Things like selling personal assets to your company. So you might own a warehouse is the best example I can give here. The warehouse is worth 200,000 euro. That's how much I bought it for. And the company has cash on the balance sheet. Company has 260K worth of cash. So is there an option there where I can, sell that warehouse to the company because the company needs the warehouse to store the product or to work from as an office or whatever that might be. It buys it off me for market value. So if the company buys it off me for market value, which is the cost I bought it for, um, I just extracted 200,000 euro from my company with no income tax or capital gains tax. So small little things like that. As I said, they go a long way. With some of our clients as well, they might need short-term funding. Personally now, and what they do sometimes is they can, with smaller companies, the company can actually make a loan to the director or shareholder. And if that loan is paid back before the end of the financial year, the director or shareholder can benefit from a tax-free loan in essence. But really relevant for small kind of owner-managed companies in many ways. So director's loan, if January is the start of your financial year, the company gives you a loan in January, just make sure it's repaid before the end of December. The cash is landed in the company bank account, just to keep the record clean. If your business is closing down, liquidation, yeah, not a happy story, but I suppose liquidation, you're talking about capital gains tax here as opposed to income tax. Capital gains tax 33% as opposed to 50% for income tax. Income tax, like we're talking about dividends, max taking out the value in dividends as opposed to a liquidation. So yeah, so look, what I would say is if you're thinking about things, and you just need a steer, talk to your accountant, talk to ourselves. We can certainly give you a steer in terms of what's available out there. There was Armin, there was a couple of things announced in the budget as well around entrepreneur relief. Entrepreneur relief is there at 10% for anyone planning to sell their business, 10% versus 33%. So that's really positive as well, for those people who kind of, like to invest, like to set up a business and maybe sell it on. Really good. Retirement relief is there as well for kind of older people who are 55 years of age or older, because there's real benefit there in terms of selling your business, your farm, or shares in a family company. Essentially, there's a lot of things you can do there tax free.
There's a lot more um, profit extractions than I had imagined. And thank you for sharing that, Tom. It's very insightful for me, and I hope for the attendees too. Again, just to the attendees, if there are any questions, please feel free to let us know. I'm going to move on to the following section, Tom. I think this goes very well hand in hand with the following section, which should be compliance with the tax regulations.
Yeah, so the compliance, yeah, I mean that's a big one. Compliance is a bit boring, insofar as, it's I have to keep up to date with the regulations. Most business owners have forgotten about what happened last year, and they're in the current. Their heads are in the current, and completely get it, appreciate it, respect that. However, the tax authorities and the company registration office and all those people who require their returns, don't forget about it, and you have to keep yourself compliant. And what we're looking at here, like, corporation tax, income tax, could be VAT, payroll taxes, and the list goes on. They're the main ones, I suppose, that would impact most businesses. So you want to keep up to date with all your registrations, requirements, etc. So as I said, your business might be registered for VAT and as an employer as well, which means kind of monthly or bi-monthly returns are required as well. No matter what returns are due for filing, make sure that either you're aware of what needs to be done and you can do it, or you put that hand in the hands of a trusted advisor, somebody who will keep you compliant, keep you right. Because most business owners tend to not have the time to devote to that which is fair enough. They've enough for doing with their day-to-day business. So get a tax agent or accountant involved. Let you focus on the day job and keeping your right side of the law. What we found, Armand, since kind of, well, with COVID, revenue were completely lenient is the best word. There was no hassle. Revenue left everybody alone. Since that all finished now, it's business as usual. So if you have an outstanding VAT return, revenue are raising estimates, and they're chasing them quite quickly, and that's the way revenue would always have operated, but they've kind of gone back to normal. Same as any other tax heads then as well. Just be aware that you just need to do your best to keep compliant, and if you feel that your head is below the water, I definitely reach out for help.
Definitely. And Tom, just on a side note, I do see that I have a question here from one of the attendees. Dermot just wants to find out if there's a daily expense allowance for directors if you are on business offsite for the day. Is there an unvouched rate of €18 per day?
There is a daily expense allowance for directors. At the end of the day, directors are treated as employees of the business as well. So there is an unvouched subsistence allowance available for business travel, tax free. There's conditions to be satisfied. You have to be away from work for 5 hours, and the director can't be reimbursed any other way. But €18 per day for absences of between 5 to 10 hours, yeah, and it's higher than that actually if you're away for 10 hours or more. €39 a day if you're away 10 hours or more. So good question. Yeah, you are entitled to. I always, Armin, just one thing on those tax-free things, payments. It could be claiming for your mileage. You're doing business trips in your private car, etc. Or this is an example. Revenue always tend to really lean into those to see if they can get tax out of those when they're doing a review. And just make sure if you are claiming these kind of things, to keep good records. That's the key. Keep records of to justify. So the date, where I was, who the customer is, or who the supplier is I was meeting, or whatever. Where and all that kind of detail. You'd be delighted to have it if revenue ever do want to check it out.
Yeah, and that will go a long way with your compliance as well that we just discussed. Tom, I'm going to move on to the final topic, which would be just discussing accurate financial forecasting.
Yes. Yes. Sometimes this can be kind of boring, but it's really important. Like knowing your numbers. Knowing your numbers is so important, because you have it there actually on the screen, profit versus cash. So knowing, what is my business doing well? What's profit, what's cash? Because profit is the money that's sitting on your profit and loss account. Essentially, it's what's left after taking account of your income less your expenses. So in other words, what's left over after all the costs have been paid. But cash, I always say cash is king. Like cash is what money's in your bank account. So the main difference between profit and cash is that profit's a measure of financial performance, whereas cash is money in the bank, and a measure of how of its ability to pay its bill in the short term. Now, what I always found interesting was it's possible for a company to be profitable, but have no money, or to have plenty of money but be unprofitable. And understanding the difference between the two of those is really important. Business simply can't operate without money in the bank, but it can operate if it's making losses if there's money in the bank. So, and it could all be down to timing where, for example, I'm making profits. I've got 100 grand in the bank, but so I've got 100 grand in the bank, but I'm not making profits. And it could be down to the timing of when I receive money from my customer versus when I'm paying my suppliers. So, I might have the money in the bank, but that money is actually committed to something, or whatever. So it's understanding those nuances. Business owners will understand them, but and for many business owners, it's looking at the bank account. Have I got enough money for this week, for next week, for the next, the next month or whatever? So this is why we put this on the agenda, because accurate financial forecasting then it really is key, because where we see business owners, mistakes that can be made is areas like business owners not forecasting at all. Like they don't forecast until maybe they need to, or they have to, or someone asks for the forecasts. So it's important even at a really high level to kind of forecast. Now, you'd always generally advise the business to forecast 12 months in advance. What do you think your sales are going to be? What do you think your costs are going to be? And you kind of do it every month for 12 months, and for the 12 months, then you've got your totals. That's not to say that that's exactly what's going to happen, by the way, because the reality then might be different. Because if the revenue doesn't happen, then how does that impact on your costs and on your bottom line, and ultimately on what's in the bank account? And if you make a sale in January, you might not get paid until March. So again, cash flow. That's why cash flow is different to profit. So areas, I suppose, just to flag, like business owners can sometimes overestimate the sales and the timing of when the business will receive the payment from the customers into their bank account, and therefore you're overestimating your cash flows, your cash inflows. So you think you're going to have more in the bank at the end of January than you will, and then in February, then you're going to be short because you hadn't forecasted for that. Managing expenses is really important as well, because some businesses tend to, they can overspend or have large expenses due at the same time. So that could leave them kind of short. Like they might have committed to paying their supplier within 30 days, but the customer won't pay them for 60 days. So you've kind of overcommitted somewhere along the way there. And it's just making sure that if you do that, if you know that, then you have got enough elsewhere to cover it. Some businesses focus only on cash flow, maybe not enough on profit, or vice versa. Profit is important, but as we know, like cash flow is really important. And then finally, the cash reserve is also really important, because businesses that don't have cash reserves really regularly get caught off guard by unexpected expenses, or could be downturn in the economy, or something that's unforeseen. Not having the cash reserve also means you mightn't have the funds there to provide the growth when the time is right. So keep the cash reserve where you can. By the way, it could be used for paying the tax bill as well. Pay the tax bill, or hiring that extra employee, or making that purchase of equipment or whatever you need. So you have a little bit on hand, just to weather the challenges, but also to provide the growth as well. Yeah. So really important to pay close attention to the cash flow and so on.
Definitely. And with going hand in hand with the importance of forecasting, I do see we have Radu, who's just asking, in terms of running costs for their first year that they plan to self-fund, what would be the most effective way of running? Any best practices for tracking the self-fund transfers and how to recuperate this cost? You mentioned software, that comes to mind, perhaps. But he wants to find out if there's any processes that we could recommend, perhaps, to streamline this.
Well, this happens quite a lot, actually. So I'm glad the question was asked. So let's just say we've got a company and we've got a director, and the director is self-funding. That just essentially means that they're providing loans essentially to the business, until it gets up and running. So director's loan. Now, what's really important here is that when that money, so transfer that money to the company bank account is what I would say. So let's say you were giving the company a loan of €5,000. I'm just picking numbers here now at random. €5,000 at the start, just to get incorporated and get set up and whatever. Transfer that money in director's loan. That goes on the narrative for the transfer, because it's really important that that's not seen as income, where it's sales. So treat it as director's loan, and then that goes into what's called a director's current account, or director's account on the software. And on the software, then, like the €5,000 and any other amounts that are actually loaned or lent to the business are recorded there, all in the same place. And over the course of the year, maybe it might accumulate to 20,000. Four tranches of 5,000. Every tranche must be marked director's loan. Now, that's great. The company's got a loan of 20,000, and for year one, there's no chance of repayment, because the business needs to be given a chance to breathe and to grow and to make some money. Year two, the business starts to do well, and has a little bit of revenue, and a little bit of spare cash as well. So the director at that stage is a choice. Do I pay myself wages, or do I claim back the director's loan that I'm owed? That's tax free, of course. So most directors will claim back the director's loan that they're owed first in advance of paying themselves wages, unless there's another strategic decision to pay wages over that. Could be that you're applying for a mortgage or something like that. But generally, they would go to repay the director's loan. Now, you can take out the full 20,000, or you could decide, no, that would put the company under. I'll just take out 5,000 now and maybe 5,000 again whenever the time is right. When you're taking that money out, just again on the narrative for the bank transfer, director's loan repaid, and then you're good. So that's the can be the easiest and most straightforward way to do this. Now, at the start though, there's no bank account. That can be a challenge too at the start. There's no bank account and can't be until the company's incorporated and set up. So at the start, there could be kind of that overlap where, you did pay some actual receipts. You paid some physical receipts yourself. It could be the company formation people or whatever. That's fine. When the company's set up, you can show them to your, if you have tax accountant or tax advisor, show them and they'll account for those and you'll get repaid in the same, more or less in the same fashion. It's just that I always find it easier for the director to transfer a block of money to the company as opposed to paying individual receipts. Let the company pay the receipts directly to the supplier, but you just loan the money to the company. Much cleaner, tax free all the way. There's no tax issue here at all. It's just it's money in, money out. It's a net nil transaction. So hopefully that helps that one.
I think there's a lot that you've given Radu to think about, and that actually leads me to the following thing I just want to mention, and I'm mindful of your time, Tom, and the attendees. If you have enjoyed, you've covered these. I'm just going to this section for attendees, and I'm popping this in our chat. If you have enjoyed today's webinar, or as a client of Knorr, you'd like to share your experience, please feel free to leave your feedback in that link that I've shared. And it's only a pleasure, Radu. That does leave me to the last section just on my side. While we are slightly over time, I just want to find out from any of the attendees if there are any urgent questions that you'd like to ask. Of course, we do realize that your tax planning is highly individualized, and what works for one business might not necessarily work for another. Like we mentioned throughout the call, reach out to your accountant, ask him these questions. If you don't have an accountant, please feel free to reach out to us on hello@knorr.com. We'd be happy to see how we can help you further.
Brilliant. Thanks, Armand.
Thank you, Tom. If there aren't any questions, I would then end it here for today. But I do thank you everyone once more for attending. And again, feel free to reach out to us.
Cheers. Have a good day, everyone.
Thank
Bye.
you. Bye-bye.